Starlink earned $4.42 billion in operating profit in 2025. The company that owns Starlink lost $4.94 billion. Same year, same set of books. Both numbers are real. If you manage your own portfolio and you are somewhere in the 30 to 55 range, you have probably already seen one of these headlines. Maybe you saw the loss and moved on. Maybe you saw the profit and got excited. Either way, you priced the wrong thing. And the mechanism behind that mismatch is something the S1 buries in segment footnotes that most retail investors never reach. That mechanism has a name. I call it the swallowed crown, and once you see how it works, you will never read a conglomerate filing the same way again. Let's start with the number that does not make sense on its face. SpaceX filed its S1 in May 2026. The consolidated headline, $18.67 billion in revenue, $4.94 billion net loss. That loss is what the financial media led with. It is also what most investors stopped at. If you are a self-directed investor who screens for profitable companies, that number disqualifies SpaceX before you open page 2. But here is what page 2 actually shows. SpaceX reports 3 segments: connectivity, which is Starlink; space, which is Falcon rockets and Starship development; and AI, which is xAI, Grok, and the X platform. These 3 businesses have nothing resembling the same financial profile. And the consolidated number blends all 3 into a single figure that accurately describes none of them. Let's look at each one separately because this is where the real story lives. Starlink generated $11.39 billion in revenue in 2025. That is 61% of SpaceX's total. It posted $4.42 billion in operating profit. Operating margin of 39%, that is not a startup metric. That is a mature, scaled infrastructure business printing money at a margin that most S&P 500 companies would envy. Year over year, operating income grew 120%. Adjusted EBITDA grew 86%. Subscribers went from 4.4 million at the end of 2024 to 8.9 million by the end of 2025. By March 2026, 10.3 million subscribers across 164 countries. Starlink controls roughly 75% of all active maneuverable satellites in low Earth orbit. This is not a bet. This is a business. The space segment is a deliberate loss. Revenue of $4.09 billion, operating loss of $657 million. But the reason matters. The segment absorbed $3 billion in Starship research and development in 2025 alone. Every dollar of that loss is an investment in the next generation rocket that reduces launch costs by orders of magnitude and eventually enables the orbital compute infrastructure SpaceX is betting its long-term thesis on. The space segment is not failing. It is funding the future. Then there's AI. Revenue of $3.2 billion. Operating loss of $6.36 billion. Capital expenditure of $12.7 billion in 2025, then $7.7 billion more in Q1 2026 alone. xAI is building the Colossus data centers, training Grok, and running the X platform. It is consuming cash at a rate that dwarfs everything else in the filing. Now I want you to picture 3 bars. The first bar is Starlink. It goes up $4.42 billion into positive territory. Green. Tall. The second bar is space. It goes down $657 million. Red but small. Manageable. The third bar is xAI. It goes down $6.36 billion. That bar is taller than the Starlink bar going the wrong direction. It does not just cancel Starlink. It swallows Starlink completely and extends another $1.93 billion below zero. Add them together, and you have the consolidated operating picture. One crown jewel, one deliberate R&D investment, one AI furnace burning faster than the crown jewel can generate. The consolidated loss is not evidence that Starlink failed. It is evidence that xAI is expensive. This is what I mean by the swallowed crown. A profitable segment buried inside a loss-making consolidated entity. The segment is producing, the headline is not. If this kind of segment-level analysis is what you want more of, this is the Paycheck Lab. We break down the actual mechanics behind financial filings so you can price what you are actually buying, not what the headline tells you to price. Subscribe if that sounds useful. Now here's the part that makes this specific situation even more unusual. It is not just that XAI is losing money, it is how XAI ended up inside SpaceX's financials in the first place. The XAI merger did not close until February 2nd, 2026. XAI had itself acquired X Holdings, the platform formerly known as Twitter, in March 2025. These were three separate companies until very recently. But because Elon Musk controlled all three simultaneously, GAAP accounting allows something called common control accounting. Under this rule, the S-1 presents all three entities as if they had been operating as a single conglomerate for every period shown in the filing. That includes all of 2025, all of 2024, all of 2023. Read that again. The S-1 shows 2025 as if SpaceX and XAI were already one company for the entire year. They were not. The merger closed in February 2026, but under common control accounting, XAI's full year 2025 losses are retroactively baked into SpaceX's 2025 income statement. The loss you see in the headline is not the loss SpaceX would have reported on its own. Here is the number that proves it. In 2024, SpaceX on a standalone basis posted a net profit of $791 million. That is not a typo. Profitable. Then the XAI consolidation hits the 2025 books and the combined entity posts a $4.94 billion net loss. The swing is $5.73 billion in a single year. Starlink did not cause that swing. Starlink actually got significantly better. The swing is entirely attributable to one accounting decision folding one AI company's losses into one aerospace company's history. Marcus saw this when he pulled up the S-1 in late May. He manages his own retirement account, a brokerage account, and a small taxable portfolio he has been building for 12 years. He is not a professional, but he reads filings. He opened the consolidated income statement, saw the $4.94 billion loss, and his first instinct was to close the tab. Then he kept reading. He found the segment breakdown. He ran the numbers himself. Starlink at 39% operating margin. Space losing money on purpose. XAI burning a category of capital he had not seen since the early days of Amazon Web Services. He did not know what to do with that. Neither should you yet, but he knew one thing. The headline was describing a different company than the segments were describing. You might be thinking the bull case here is obvious. Starlink is the engine. Strip out XAI and the core business is printing money. Space plus connectivity adjusted EBITDA combined is roughly $7.82 billion. The loss-making AI segment is a bet, not a verdict. And the Anthropic deal, where the AI company agreed to pay SpaceX $1.25 billion per month through May 2029 for GPU capacity, annualizes to $15 billion. Nearly equal to SpaceX's entire 2025 revenue from a single contract. That is the legitimate bull case. And it is real. But here is the part that deserves equal weight. The Anthropic contract has a 90-day termination clause after the initial period. That $15 billion annualized number is contracted, not committed. XAI CapEx hit $7.7 billion in Q1 26 alone, more than the entire 2024 AI budget in a single quarter. The acceleration is not slowing down. The bridge loan sitting on the balance sheet is $20 billion short-term, due within 6 months of a successful IPO. And the IPO is targeting a $1.75 trillion valuation on a business that lost $4.94 billion last year. That requires a specific kind of faith in future cash flows that segments, however healthy, cannot fully justify on their own. The bear reading and the bull reading are both wrong if they stop at the consolidated number. This is what I call the conglomerate discount problem. When three fundamentally different businesses trade under a single ticker, the market cannot efficiently price any of them. The Starlink multiple gets dragged down by XAI's losses. The XAI optionality gets discounted because it is buried inside a satellite company. The space segment is barely visible in the noise. You're not buying a company when you buy SpaceX. You're buying a bundle. And bundles are almost always priced at a discount to their parts. The question every self-directed investor needs to answer before pricing this IPO is not whether SpaceX is good or bad. It is which of the three businesses you are actually underwriting. Because the S1 will hand you one number, and that number represents all three at once in proportions that could change significantly as XAI either finds its revenue footing or continues to accelerate its burn. So here is the protocol. 3 steps you can run before the roadshow closes. Step 1 is the segment isolation test. Pull the S1 segment table. Write down Starlink operating profit, space operating loss, and AI operating loss as 3 separate numbers. Ask yourself what you would pay for Starlink as a standalone business at 39% operating margin growing at 50% per year. Then ask what discount you apply for the obligation to fund XAI until it either earns or gets spun off. The gap between those two numbers is your real investment question. Step 2 is the CapEx trajectory check. XAI spent $12.7 billion in CapEx in 2025, then $7.7 billion in Q1 2026 alone. If that rate holds, AI CapEx in 2026 could approach $30 billion. Starlink's adjusted EBITDA in 2025 was $7.17 billion. The math of how long Starlink can fund XAI at that burn rate is not a detail. It is the central question of the filing. Step 3 is the common control calendar. Go back and note that the S1 presents 2023, 2024, and 2025 as if the conglomerate always existed. It did not. The merger is 6 months old. Every trend line in the historical financials is a blend of entities that were independently run until recently. Treat the history as context, not as a track record of the entity you are actually buying. Here is the reframe. Most investors will read this filing and price a loss. Some will read it and price a satellite miracle. The investors who will actually understand what they are buying will read it and price 3 separate decisions. Starlink is a mature infrastructure business with 39% margins. Do you want to own that? The space segment is a long-duration R&D bet on Starship. Do you believe in that timeline? XAI is an AI infrastructure play consuming capital at a rate that assumes future revenue no existing contract fully guarantees. Are you underwriting that? The number on the cover page does not tell you which of those 3 bets you are making. Only this segment table does. And most investors will never get there. That is the swallowed crown. A $4.42 billion profit sitting inside a $4.94 billion loss. Both numbers true. One number visible. One number doing all the work. If you are a self-directed investor in your 30s to 50s who reads actual filings and wants frameworks for pricing what the headline buries, subscribe to the Paycheck Lab. We publish one of these every day. Drop a comment below with which of the 3 segments you think deserves the most weight in the valuation. Starlink cash flows, space long duration bet, or XAI optionality. I read every one.